Welcome, guys. Matt Simmons here, back with another episode of the Remind podcast, where we talk all things real estate minded. Today, I have an awesome guest on with us. Actually, Josh and I met probably about a year or so ago now, I think, in Wisconsin, no less, at an event that we were both at. And he's actually based up in Ontario, Canada. He is the principal broker at Synergy Mortgage Group, as well as a real estate investor, both in Canada and in the United States of America. Please welcome Josh Perez.
Thanks for having me, Matt.
How are you?
Good, man. How's everything going with you?
It is good, man. It is good. So give us a quick little bio of you, what you guys do, what your focus is, because I know you're spread across two countries, so you're doing more than even we're doing because of that. So give us a quick little bio about yourself.
Yeah, so kind of just as you mentioned, so, kind of primary day job, day business. I'm a mortgage broker and partner at Synergy Mortgage Group. So we're a mortgage brokerage in Canada that I would say the primary business that we help Canadians with is residential homes or investment properties, 4 units or less. That's kind of considered the residential mortgage side of things in Canada. So I worked at a big bank, started in like 2009. And then part of my journey also of getting into real estate investing started around then, where, just a couple of buddies, we would meet every once in a while and just kind of talk about, hey, like, we want to start a business. We want to do more than kind of just a day job.
Right.
And we'd meet and start talking about all kinds of different topics. And then, we got on the topic of real estate, and then we're like, yeah, we want to, look at like flipping homes, all these, flipping houses,
Right.
TV shows and stuff are super popular.
Make it look easy and glamorous.
Yeah, exactly. Right. It's super easy. So, we started looking at that, and then we got into exploring renting and holding property long term. We attended a few conferences, joined a community group, and decided, this is something that seems to be a bit more sustainable and diversified for the long haul. So yeah, we literally just again, we were a bit younger out of college, didn't have too much money, and we just opened up a joint bank account and just started saving money for probably like a year for our down payment. And then in 2010 we bought our first investment property. It was a duplex, and man, I talked to people because I'm still in that same market where we bought, and we just say, back in 2010, like, we bought a large, nice 2-family home duplex. And we bought it, I think, for like $208,000. And now that same property probably goes for, I gotta say, like closer to $700,000. At that time, like, we had our pick then for literally duplexes, triplexes, good areas, A, B neighborhoods. And it's funny to think back at how times change so quickly in real estate. And, if you can kind of just, in my opinion, get into assets that can generate cash flow, or you have a path to generate cash flow, you can hang on to realize that appreciation. So anyways, back to your question, and my long-winded story was, getting into real estate investing really kind of started to kind of spark a few ideas for me. And I noticed myself becoming, more and more passionate about real estate investing and how it, has been kind of a time-tested way to build wealth over time, right? So working at the bank, I was doing investments, mutual funds, retirement planning, and then also mortgages and credit. And so, up until 2014, we acquired a few more properties. And then it was in 2014 where I said, you know what, I just really want to focus on real estate investing and maybe the credit side and the mortgage side, which is tied to real estate. And so I learned about, up here is called like the broker channel, or being a mortgage broker, where you don't work necessarily for one lender. You have access to, 30, 40, 50 different lenders, but you don't work for one. You can be your own business. So in 2015, my one partner worked at another bank. We kind of built a team, started brokering. And then 2020, thankfully things grew. We opened up our own brokerage. And now we have a group of about 33 agents that work with our brokerage, as well as our own team. And yeah, so in terms of the clients we help, like I said, residential financing primarily is like 80% of our business. And it's an even split between people, buying, their first home or their next home, or investors, right? And then since we've been kind of scaling up our portfolio, so presently my portfolio is at, about 90 doors. And over the last 4 years, I've kind of focused more in the smaller apartment building space. And so because we have a really good reputation here on the residential side, I've just been kind of reluctant to offer our services on the commercial space until we really built the right infrastructure and expertise across our whole team of understanding, the journey associated with commercial financing that is completely different.
Right.
Res financing. So nowadays, focused on continuing to grow my client book and mortgage business. We're expanding into more multifamily and commercial financing within our brokerage. And investing in real estate is just one thing that has to be a constant throughout, regardless what the day job or the business is. And that's kind of where we're at right now.
So you're pretty much taking your income that you're making as the partner and the principal broker at Synergy, and then taking that income and dumping it into investment real estate.
Honestly, it's a very kind of simple way of putting it, but I hear from time to time I chat with more people and a little bit more experienced or higher net worth, whatever, but they're in real estate. They said your job is to take the money you earn here and just keep moving it this way. Moving it this way. And it's just a funny analogy that's really animated. It's really stuck with me. And it's like, you have your basic, your living expenses. And, when you work hard, you want to enjoy some things. That's important too, and take care of your family. But like, you constantly got to be looking at, what's around the corner. Things can change. The goalposts can move like we've seen over the past few years. So just, success and paths to building wealth could move in one direction for the longest time, and all of a sudden it can just all change. So I think it's super important that you're constantly looking for opportunities, connecting with people. That's been a big topic that I've kind of chatted about with kind of my own network and lately, is that equally as important as educating yourself in a particular area of investing, I find now is building your network and connection. People who ultimately end up being, resources for you, and you can be a resource for them. And that leads so much.
You become, and we hear it all the time, and it sounds so cliche, but I mean, it's really true. You become who you surround yourself with, right? So if you're surrounding yourself with people, this is like what I talk about this all the time. Like, these people that constantly surround themselves and still hang out with the same group that they hung out with in high school, or college. It's like those people are holding you back. They're pulling you down from achieving your goals, because most of the time they're not thinking as big as you are, right? At least in my case, I know they're not, right? So I just refuse to surround myself with people that are going to pull me down to their level. I want to surround myself with people that are going to pull me up to their level, right? And it's funny you brought that up, because you and I talked about it maybe a week or so ago. It's one of the reasons why I'm building out that group that we call the syndicate, right? Is to really bring these people together from all different backgrounds, not just real estate, but from all different business backgrounds, sales backgrounds, experience backgrounds, to really help each other out and become a resource for each other, to help, people like, me or you or whoever it is, kind of take their business to the next level. Because we all hit plateaus. We all have problems that we have trouble figuring out a solution to. And, if you network with people that have been there or have more experience than you, all that's going to do is help you achieve your goals and get you to the levels that you want to get to.
Couldn't agree more.
So you're invested in both Canada and in the States, right?
Yes. Yeah.
So what do you see the difference? And this is something I've been wanting to actually talk with you about for a while. What do you see the biggest difference between Canada and the US as far as real estate investing goes?
Yeah, so I gotta say, I'm definitely not, an expert in the U.S. and the markets that I've started to dabble in. What I could kind of maybe some background on how I got into, investing in the U.S. was just that couple of years ago, when the world was changing and we had, lockdowns were really bad and really bad. We were lucky that just prior to this happening, my brother and I wanted to help my parents purchase a secondary home in Florida.
Right.
We're familiar with that area. So we had just kind of got that in play. And then we went and stayed there over the holidays, and lucky enough, working in mortgages, I'm grateful we can work remotely. So over the holidays, we're just like, man, like we don't want to go back. It's brutal. Nothing's open. There's all these rules. And Florida is like amazing right now. Right. And like, I'm like, perfectly normal, everyone's safe, do your own thing.
Right.
And so we're like, you know what, we're just going to roll the dice and we're just going to stay here for a bit and just work. And so we stayed there for 2 months, had a friend visit, he was in Mexico. He works remote. He came and hung out with us and literally just be like, my brother and I like literally working like 9 to 5 every day.
Yep.
But then after that, we can go for dinner. We can go hang out.
You actually could still live your life because you're in Florida. Yeah.
Exactly. So, as a real estate investor, I find most, you tend to get curious about, places and what's going on in different markets as you visit from a real estate standpoint. So we're spending this time in Naples and right away knew that like we ended up buying another place in the same community. But while we were there for 2 months, it's just general curiosity, like what opportunities exist here in Florida. We were in Naples, right? And we come from a background of investing in multifamily, value add type properties and looking at kind of refinancing, pulling capital and putting
and redeploying. Yeah.
In Naples, it's it's a lot more of an affluent city and price points just for that strategy. It's really a thing. Not really a thing. Yeah. So we're like, okay, we can, maybe explore, 2-3 hours away, a smaller market where that strategy might make sense, or we can kind of stick to our home base where we are in Naples and see what opportunities exist there. And so just got, like we're talking about people, I got connected, with a younger guy kind of in the same age group as me who was a realtor. He's also an investor, golfer. We golfed a few times and started to chat. And he was investing in this area, like kind of up and coming area that was kind of gentrifying a little bit and close to a beach. And basically a strategy there was like, people tearing down houses, building new and short-term rentals. And, we looked at some data there. And it just seemed to make sense upside, downside there with regard to, buying, building. Our goal is going to be to refinance. We'll see where the market is. And we still got about 6 months. So who knows? So, but the income piece, which is always, our fundamental is like, listen, you got to leave capital in a project, that's okay if cash flow is being generated. It's not okay. You don't have cash flow. You can't pull capital. That's the problem, right? So that's what we're at right now. We're about 4 months away from 6 months away from one of the builds being completed. We'll see how much capital we leave in the project. But the cash flow numbers are looking very, very strong there. Good. And then
and that's short-term rentals? You're doing short-term like Airbnb, VRBO stuff there?
Yeah, and this is both build and the short-term rentals is something new for us. There are people who are doing it here, like in our market on Ontario, like and doing very well with it. It's just needs to be more actively managed, or you have to find the right partner there. But what I've learned, I'm also part of a few investor groups that are bringing boots on the ground to different areas in Ohio and in Tennessee and Florida. And the U.S. is bigger in population than Canada, maybe not in actual size, but I see the opportunity in terms of like price per door from a Canadian and looking at the price that we have to pay, let's say in Ontario for a property, just the price per door is the big allure for Canadians wanting to come into the US. Now it's all relative based on the income you can generate. And the appreciation, but that's the biggest thing that intrigues me is my capital potentially going further.
Goes further,
investing in the right market when done correctly, of course. That's the big thing for me, I would say.
Okay, no, that makes sense. Yeah, I know price points in Canada kind of, everywhere they've skyrocketed, but I know in Canada specifically, like Ontario. To be able to get into something and try to cash flow on it right now is pretty much next to impossible.
It's very difficult. When you say that, I know what you mean. And in the sense of like, putting down a reasonable amount of capital.
Right. Exactly.
You know what I mean? Yeah. You can cash flow anything, if you put 60.
If you put enough down. Right.
But if you're looking at putting, 20 to 30% down, even 5% down, you don't have your look at anything, right? It's a little challenging. And for people who are wanting to grow and accelerate their wealth, they might not have infinite sources of capital to just plant in a property for 10, 15 years, right? So the people that we're working with and helping the most are those that, we're looking at a 1 to 3 year plan of turning that capital over, stabilizing an asset and needs to generate cash flow, and boom, looking at doing that again.
So what's your focus moving forward? Is your focus primarily in the States as far as adding to your portfolio, acquiring more properties, doing more build to rents, et cetera? Is that kind of a strategy that you guys are focused on moving forward?
Yeah, so I think the apartment building multifamily space value add right now is definitely always on the horizon. It's just like, can you find opportunities that make sense? So that's definitely always going to be on the radar in Canada, in Ontario, and then out of province, we're looking at Alberta right now.
Okay.
So that's for sure always going to be on the horizon. But yeah, we're going to probably wait until these Florida projects wrap up, which should be like Feb for the first one of 2024, and then probably a couple months later for the next one.
Sure.
And once that's wrapped up, just kind of reassess, right, Matt? Like the market and things can change, right? And that's, that model is definitely one that, maybe if, like I would call it, is like doesn't have as many outs, let's just say, as a multifamily play that I'm still learning. Sure. I want to see how these end up, but I know I do want to get into the multifamily space in the US. It'd be nice if we could get close to us in Florida, but go out of market, it's fine. You just got to build more relationships and more contacts. That's really what it all comes down to.
Yeah, I mean, and I that's kind of why we as a firm really don't buy anything in Pennsylvania, because we don't feel like it's a good market to buy in. The types of properties that we want to buy, there's not a ton of them out there in the first place, and the ones that there are, there's just so much competition for that we don't even want to get into that. And at the same time, you're not seeing the growth in Pennsylvania that you see in a lot of other markets, and that growth is what really drives the valuations and the equity multiples up for us and our investors over time. Because if you're not having a population growth, you're not getting rent rate growth, and if you're not getting rent rate growth, you're not getting value added to the property that gets you the exit price that you want to get 5 years down the road, 7 years down the road, 10 years down the road, whenever it is that you're looking to sell. So that's why for us, we primarily target, for our multifamily, whether it's value add or institutional fund, we target those, the Sunbelt areas, North Carolina, the South Carolina, the Georgia, the Florida, the Texas, the Tennessees, the Kentucky, because we know there's growth there. We know that rent rates are going to continue to increase, and we know the valuations are going to get to where we want to get to. So here's a question I have for you, and I always ask people this based off the state of the current market and the economy, and who knows from one day to the next what's going to happen. Where do you see, and you're in the mortgage space too, right? Now you're in the mortgage space in Canada, but I think there's a lot of synergy back and forth, and I think things follow each other fairly well. Where do you see the market as a whole going over the next, let's say, 12 to 18 months?
In terms of interest rates?
Yeah.
Yeah. So, like a year ago, we'll just say, like, in my head, and, maybe like, I haven't, I didn't live technically through, the 70s, 80s, like, not being an infant, let's just say, where I saw like crazy high interest rates. But, yeah, it wasn't in the realm of like in Canada, we've seen interest rates go up like 4.75% in like 12 months, less than 12 months.
Sure.
Okay. And so in the realm of outcomes like that, just a year ago, it just wasn't something that I anticipated really being possible based on all the information we got. Now, a year later, I learned that, when you're listening to economists and analysts and experts, like the reality is that nobody actually knows.
Nope.
They're just speaking to the most recent information and data they got within the last week. And then that information can change by next month. So, for example, in Canada, January was like just into the new year we had the last kind of rate hike for a while. Mm-hmm. And, I know, like owning a home in Canada, and what I suspect in most of North America, is like a very major milestone for most people and families, right? So that inherent goal, I don't see that changing anytime soon. Mm-hmm. It's still a goal for many people. People have the desire and the want, and they do it as different for it, but they want that. And then also building wealth through real estate is a very now mainstream thing, time-tested way of building wealth, and that desire has only grown. So that leads to people wanting to buy real estate. I don't see that changing, right?
Sure.
But what we saw in January with like a very big slowdown, like we saw prices decrease in markets 15 and 25% over the last year. Okay, not all markets. It's very kind of
Right.
location based, but that happened. And volume of transactions, the mortgage industry decreased by anywhere from like 40 to 60%. So there's a huge downtick. Okay, but what we saw when the sentiment of rates no longer going to be increasing or speculating that they're going to be stabilized for a while, we started to see price increases,
Demand coming. Yeah.
happen. Right?
Yeah. Yeah.
And then it was all like, then, the analysts, the experts are all like, okay, so is there going to be a rate? Oh, is the rate cut going to be, end of summer? Is the rate cut going to be in the fall? Is it going to be in December? Is it going to be early 2020? That's the whole, if you pull up, all articles, all media sources, that's what everyone's talking about. And that's the conversation. And then all of a sudden, I'm just looking for like a calendar, we're in mid-June, probably about a month ago, you start to see a little sprinkle of, this latest inflationary report didn't decrease much as we thought. It was almost just flat.
Right.
And then you start to see, there might be
another rate hike. Yeah.
Then a week later, definitely going to be a rate hike.
Yeah.
And then there's a rate hike, and now it's like, boom, there's going to be another one, or there might be two.
Yeah.
And now, boom, everything is like
flip back around. Yeah.
But in my opinion, if inflation next month or the month after comes back down, that's all going to change.
Right.
Yeah. If it stays stagnant, then we're probably going to see a rate hike.
Yeah.
So honestly, I don't have anything exciting to say. What I've determined is that everything right now in Canada comes down to the most recent inflation report.
Yeah.
That's concrete.
It's kind of the same thing here in the States. From one week to the next and 1 month to the next, you're seeing people, overreact and then correct, and then overreact again and then correct. And I think that's society in general nowadays, right? So I'm gonna go back a little bit and let's talk about 12 months ago, 14 months ago when rates started going, really kind of going up, right? People were starting to freak out. Oh my God, rates are skyrocketing. They're through the roof, blah, blah, blah. And I'm like, guys, you really don't understand. You got to look at things in perspective, right? And I think it's a hard thing that people have. People can't look at things with the right perspective anymore, right? They look at it so narrow-minded and short-sighted. And it's like the average rate over the last 30 years here in the States is between 5.5% and 6%. Right? Those 3.5% interest rates, those 3% interest rates that we had 18 months ago, that's not sustainable long term. That's solely due to COVID, right? They artificially kept rates low. They influxed a ton of money into the system, into people's hands, which is why we had the inflation that we had. And that kept those rates where they were at. And so you had this giant amount of demand. And that leads me to the demand that was there with those low interest rates. You had this huge demand that came into the system all at once because everyone was like, oh my God, look how low these rates are. I can now afford the house that I actually want to buy that I couldn't afford before when rates were at 5%, right? So you have all this new demand that comes in, which is then just competing for the same amount of inventory that's on the market because there wasn't a ton of new inventory hitting the market, and that's just driving prices up, right? And they kept relating it to the crash of 2008 all over again. I'm like, this is not going to be a crash like 2008, guys. It's completely different. That was speculative lending or speculative buying based off of subprime debt lending, which led to that crash. We don't have that speculation. We don't have the bad debt being given out now. It's simply a supply and demand issue. And so 18 months ago, 12 months ago, I'm saying the same thing I'm saying now, and that is we're not going to have a crash in the residential sector. You have to let prices correct, but they're not going to come crashing through the market because in order for them to come crashing through the floor in this market, you have to completely eliminate the demand that's still out there, and you have to have this giant influx of inventory to hit the market, and you're not going to have either. No. Because rates still aren't bad, and people. Until you start explaining it to people that way, they still think it's going to be 2008 all over again. And they're sitting there waiting for this crash to happen to buy that's never going to happen.
Man, on the supply, speaking to, we talked a little bit about demand, and then on the supply side, like again, in Canada, supply, like the lack of supply is such a huge topic here. I'm sure it is in a lot of markets where in the US. But there's a couple studies now where, because it's also now it's getting deeper, right? With some people talking about this is just, okay, lack of supply. We need to build more housing, right?
Right.
For these builders that sometimes get a bad rap, there is like such limited incentive for them to build here because there's so much red tape. There's a study done in kind of in the GTA or Greater Toronto area, Ontario, saying that like the average cost of a new build being sold to market, 30% of that cost is going to taxes, development, fees, government, right? And it's just, and I have some builder friends at different experience levels. Like as a business owner, like, I'm sorry, like you're not going to go and build something that and take on that amount of risk and debt. When there's a huge opportunity for you to take a huge loss, that could be the end of your business, your life, your family, all these things. Like it doesn't make the cost, because again, there's
the risk reward ratio is skewed for sure. And then the government's going to blame them, but it's the government that's keeping them from actually being able to go out there and build what needs to be built for people to be able to buy.
Do they want to solve the supply issue?
They don't. They don't. No, I mean, I see it. I mean, I'm building a new house. I bought some property here in north of Pittsburgh that I'm actually building my final home on. And just the red tape that I have to jump through for the permits and the utility tap-ins and everything there. I mean, it's ridiculous. Imagine having to do that with a whole development on, and I have before. My family owns 60 acres here in the area. That they bought in like 1983, I think it was, that my mom sold about 5 years ago. And we sold it to a developer. There was 60 acres. They were going to do like 45, I think, home sites on it or something like that, 40 home sites. It was a 2.5 year long process to go from contract to actually closing on the property with the developer because of all the hoops and the red tape that we and the developer had to jump through to get it through the supervisors and the planning commission and get all the permits, get all the approvals. 2.5 years to get all that done. They couldn't break ground. We didn't even actually finally buy the property from us until 2.5 years after we went under contract because of all that, the hoops that you have to jump through. So from a builder perspective, I get it. I mean, why take on that risk?
Exactly. So, I mean, it's just, so how we got into that supply and demand thing was like, okay, are we going to see prices crashing and comparing to 2008? And it's a very different. And I couldn't agree more. There might be some corrections, largely due to I think affordability. And you're using the example of debt. Again, this is local to my market, but it's perfect for a lot of people, right? So we have a lot of first time kind of investors looking at converting single family homes to duplexes, we call them, or family homes, right? Yep. And this was like one of the most desirable asset classes in the peak of during COVID and when rates were here. You mentioned rates for you guys. Our lows were like 1.5%, 2%. Oh, wow. Yeah, it was
2.5%, 2 3/4, but it came back up over 3 pretty quick.
Yeah, if you took a variable here and it was like an owner occupied property, you could have gone as low as like 1.4, 1.3. Fixed rates were in like the high ones. And then if it was an investor mortgage, it might have been low 2s. So still like crazy. So at that time, you could break even on one of these duplex properties if you bought it like just over $1 million. It generated like top rents, if it was fully renovated, would generate about between $4,200 and $4,500 a month in rent, and you could cash flow it or break close to even if you paid like just under 1.1, I think what the number was, right? Yeah. Now that property, like at current debt rates, you're going to be at like $700,000,
$650 to $700,000. Yeah.
So that's kind of like where the affordability piece and where the rates are that leads to an adjustment, obviously.
Sure. And that's needed. And that's what I've been saying too, is during that time where rates were so low that there was this huge demand and low supply, that drove those prices up. And they drove those prices up to levels that weren't sustainable either, right? So you're going to have to correct from those inflated price points, right? And that's why, like, over the last 6 months, you see people like, oh, prices are dropping or prices are crashing in this market or that market. It's like, no, they're not crashing. Yeah, they're coming down, but they're coming down to normal levels that you would have seen at that standard 3.5%, 4% year-over-year price appreciation if you go back to 2019 and look at the standard rates through today, standard appreciation year-over-year rates through today. That's realistic. A 20% price hike or price increase, in 12 months isn't sustainable. It's not realistic, and it's not even good for the industry.
Yeah.
And people have a hard time kind of logically thinking about it that way until someone actually knows what they're talking about or in the industry can sit them down and be like, look, this is what's happening. This is why. And even a lot of real estate agents don't know that, right? Because A, they're not paying attention, or B, most real estate agents, as we know, just are useless at what they do. Let's be honest. They
don't look into like numbers and data a lot of the time.
Right.
And just that gets passed on to clients who are just, buying on spec or hoping, real estate just always goes up. Okay, but what if it doesn't?
Right.
Again, it's back to that affordability piece, and whether it's investor or that. But here in Canada, like, although I was talking about those price adjustments, the multifamily apartment building space, they've been holding pretty steady. They've been holding pretty steady. There's definitely been a downtick where you more deals that you can get. Like we reference, in Ontario, like price per door. So we have like, our primary markets, our secondary markets, even our tertiary markets. So what we've been kind of doing is targeting secondary and tertiary markets, trying to get in a value add play at, so, 125, 150 a door is kind of the target. And then, refinancing, those markets can get up to like anywhere from 250 to 350 a door. At the end. But it's tougher and tougher to find stuff sub 200 a door. In those markets here. I don't know what it's like where
it depends on which asset class. In our class B, class C stuff, you can get stuff 75 to 95 a door. In our class B plus A, you're upwards depending on the market. If we're in Florida, we're 300, 350 a door.
That's a value add or a turnkey?
No, that's a turnkey. That's going to be a turnkey. That's like for our institutional fund. That's going to be a turnkey type of property. That's longer term appreciation, just regular cash flow type of play.
Gotcha.
It's all market based. If we're looking at Tennessee or Kentucky, our price per door is, that 75 to 95 range. North Carolina, South Carolina, you're probably 150 or so. And then, as the further south you go, the closer to the beach you go, obviously, the higher that number gets for sure.
Sorry, I did want to ask you something because so in the multifamily apartment building space, a value add type of asset, say B type quality, what states do you like opportunities in right now? Would you say you'd be focusing on?
North Carolina, South Carolina, Texas, and Tennessee. South Carolina kind of being at the bottom of the list, but it's on there. But definitely North Carolina, Texas, and Tennessee. We see a lot of opportunity in those markets for that type of property, and we're looking kind of. We do look in the primary markets, the big markets, the Charlottes, the Dallas, the Houston, but we do like some of the secondary markets like San Antonio, Frisco, Fort Worth, Raleigh, Durham, stuff like that.
Very cool. Do you do have you explored, do you do anything in Ohio?
So our affordable housing portfolio is a lot of our holdings there are in Ohio, but nothing multifamily wise, nothing bigger multifamily wise. Everything's in Ohio is in our affordable housing. Gotcha. Cool. It's not a bad state. There are some multifamily, especially value add. If you're targeting value add, there is some opportunity in Ohio. I like to tend to stay away from snowy states though for multifamily because you have that population. And we talked about this before we started recording, but we have that population growth factor that we always look at, right? Where are we seeing population growth? And a lot of people are leaving the snow states, moving to the south, moving south to get away from the snow. which is going to increase your population. It's going to increase your rent demand. It's going to increase your rental rates, which increases your value, your net operating income and your cash flow, ultimately increasing the valuation of that property. So that's kind of the mindset there for us, anyhow. Yeah. But a lot of people are successful at investing in those states. It's just not our business model. It never has been.
Well, you want to put as many kind of factors of upside in your corner, right? And
absolutely,
it's a clever one. I personally haven't. I wanted to spend more time in Florida, and I personally I'm looking down there,
right?
But to actually categorize it sometimes. Don't always think about it, but it's no question. You just look at your average person, right? We're just talking. We're just like, I'd rather not be in the snow. So
if there's 100%.
Australia, it's clever.
And you saw a lot of that during COVID shutdowns too. People leaving and I'm not going to get political on here. I think everyone knows where I stand. You already know where I stand. You stay in the same place as I do. We've had this conversation before, but you saw a lot of people leaving those heavily locked down blue states to red states as well. And so for something that we always do is we will not invest into a blue state ever. We are only going to invest in red states. They're more landlord friendly. It's easier to deal with the red tape. It's easier to deal with any of the government entities, tax benefits to it as well. And eviction, they're landlord friendly. So if you have to evict, it's much easier.
Yeah. No. Okay.
All right, man. Well, I appreciate the time you hopped on here with me. It was a blast talking with you. Where can people find you if they want to find you online?
Yeah, best place to reach me would just be probably on Instagram _Perez Josh or at Synergy Mortgages. Love to connect. Always fun talking real estate. I'm glad you reached out, man. It's been a little while, and I'm always super kind of curious as to what you have going on and what you're building. It's a really special thing, and it's very, very impressive. I'm flattered and appreciate the opportunity to chat with you.
No, man, I was pumped to have you on. I'm glad we reconnected, and let's stay in contact after this. And we'll talk soon.
Thanks, man.
All right, buddy. Thanks.